There is a lot going on for Canadians these days. There's, geopolitical uncertainty, there's uncertainty about the job market, and a lot of people are having a hard time making ends meet. For those who own a home, some of them are considering either applying for or drawing from a home equity line of credit, a HELOC. And today we're going to talk about some of the pros and cons, some things to think about as you, factor that into your financial life and how you make your borrowing decisions and spending decisions. Our guest is Ron Butler, principal broker at Butler Mortgage and host of the Angry Mortgage podcast. I smile every time I think of that name. He joins us to talk about the HELOC and the pros and cons. Hello, Ron.
Hi, thanks for having me on.
I just love the name of the podcast. I'm going to have to rename mine with the word angry in it somewhere. It's just because I don't think of you as being angry. Are you actually angry?
Oh, hell yes. Yeah, absolutely. I can be angry at the drop of a hat. No problem at all.
Oh my God. So I'd have to call mine, I don't know, the Deluded Optimist podcast, because that would be my starting point. HELOCs are a thing. They've been a thing for a very long time, but in this day and age, there is a higher likelihood that people are dipping into them for all of the reasons that one can imagine. Definition first. Home equity line of credit, how does it work?
So home equity line of credit is a line of credit that has been secured against your house. So it comes in different shapes and forms. You may have gotten a mortgage and the bank just tacked the line of credit onto it and said, hey, look, you could have this. It's $50,000 line of credit where it's going to be secured with your house. It just comes in conjunction with your mortgage, and you can use it for emergencies and things and renovation and stuff. And it's just a good thing to have. Okay. And there's another kind of line of credit where you apply for a separate line of credit that will be secured against your house. But in the end, it's all the same. They're the same looking contracts. They have the same provisions, and they are definitely secured by real property, by your house.
And the rate is substantially cheaper than if you were to put that renovation on a credit card.
Oh my God, yes, it's much cheaper. It's typically prime or prime plus a little, like prime plus 0.5%. So most HELOCs we see are at 4.45, 4.45, or 4.95, which is a lot cheaper than your credit card. Yeah, no kidding.
And what's your requirement to pay back? So say you tap it for 50 grand. What are you required to pay each month?
Excellent question. So for the vast majority of HELOCs, 98% of HELOCs, you are going to be asked to pay the interest, the monthly interest that accumulated. Nothing else, no principal. You're not paying down the mortgage. You're not paying down the loan. You're not paying down the line of credit, but you must pay the interest on the line of credit every month, which makes for a relatively small payment.
You mentioned that banks often will just add them on to your mortgage. Are they relatively easy to qualify? How much equity do you have to have in your home in order for a bank to be willing to add one on?
Well, the limitation for most banks in participating with a line of credit is the combination of both the mortgage and the HELOC cannot exceed 80% of the value of the house.
Right. So if you've got some equity, say you've owned your house for a while, or the place where you happen to have bought has increased in value dramatically, you may have some more room there than if you bought your house yesterday and it hasn't appreciated at all.
Sure. And let me tell you about an intriguing product that some banks offer. Quite a few of them do offer, in fact, the big banks. They would say, okay, we're going to start you with a $100 HELOC. It's going to start at $100. And then every time you make a mortgage payment, a chunk of your mortgage payment is going to pay down your mortgage. Hence, it will create more equity in your property, just a simple paying down of your mortgage. So what we'll do is every time that mortgage pay down happens, when you make a payment every month or every 2 weeks, we're going to increase your HELOC by the amount of the equity that you've just created by paying off your mortgage. And that's how they work it. So you could look back in 2 years and you say, my God, that small HELOC has now grown to $10,000 or $20,000. So there's many ways that banks use to make sure that you are involved in a HELOC. They have many techniques.
There are ways that you can use that HELOC that I think many personal finance folks or people in the sector would say those are pretty good reasons. Like you've got a roof that needs to be repaired and you put the roof on and you withdraw that money from a HELOC, or you need to buy a kidney on the internet, and you're going to put that on the HELOC. So there are some things that are like, yeah, okay, good. Other examples of drawing money out of that HELOC that may be more controversial. What are some examples that you have seen that you think, oh, I wish I could have been there to counsel that client not to do that?
I think I would even be, I'll leave the kidney alone, but I think I might even be inclined to counsel the client to say, look, the roof expense is not that big unless you've sprung a leak. Let's try to see if you can't save up the money to be able to manage that repair instead of accessing a HELOC. But we've seen all kinds of examples of unfortunate decisions. A HELOC to go to Jamaica on holidays, a HELOC to, because it's a lower interest rate, a HELOC to pay off credit cards, which are at a higher interest rate, which might seem sensible, but then of course the credit cards just refill up with more debt. So it becomes an excuse to overuse credit cards. By the way, I'm not trying to paint every person as a poor borrower, a bad borrower, that they just do things frivolously. That's not true. I have just as many clients who have never used the HELOC in history, never taken one penny out of it, as we do clients who've taken out a ton of money. I mean, it's really about different philosophies. But yeah, I've seen a lot of things that I don't think were a great idea, and possibly the most dangerous one that is sometimes recommended by real estate agents and some mortgage brokers is to use the HELOC to access a line of credit to buy a rental property. Okay, so that was something that has gone on in the past. We've seen a bunch of it. And today, in today's real estate market in British Columbia, particularly British Columbia and Ontario, that's had some poor results.
When people are faced with really challenging circumstances and finite resources, there are some priority calls they have to make. So I'll give you an example of one that I heard recently of an individual who was in a very tough time, married person, some assets in an RRSP, 80% equity in a $1.3 million home and an untapped HELOC, and some credit card debt, say 30 grand in credit card debt. How would you counsel someone to think through the different options? Put it on the HELOC, pay off the credit cards, cash out the RSP. Like, how would you help them think that through?
Well, unfortunately, the RSP cash out is problematic in this country. You will pay you'll pay taxes. You will have withholding taxes when you pull the RSP money out, so you'll end up with less money. You've lost that advantage. The whole advantage of having money in the RSP was it grows on a tax-free basis. So it really should be a true emergency. I mean, it really needs to be because you're taking such onerous penalties on taking the money out. So use the line of credit to pay down credit card debt. I'm not a big fan. I mean, I think that's a debt cycle that people should really try to avoid. You always have to ask yourself, why did the credit cards get run up in the first place? How have I mismanaged some of my spending? We should take a closer look at that. So I'm sort of like the overweight Dave Ramsey of Canada, that I'm trying to think of ways for people to not use debt, access debt to pay more debt. Is something I've tried to avoid.
Yeah, it's an interesting position for someone in your line of work, given that mortgage brokers get paid on having people take on debt.
Sure, they do. But what I've come to learn after all these years in my business is, if you talk to people about the reality of what happens and what can go wrong, eventually they'll come around to say, well, maybe I should use that overweight guy for something else. Maybe I should use my more.
He's learned a thing or two.
Okay.
He may be angry, but he's learned a thing or two over time.
Yeah, so it doesn't hurt your business in the long run, to tell the truth.
I agree with you. Let me ask you this in terms of consequences. So you miss a mortgage payment. Things really do not go well for you. There's a lot of things that lender will do to ensure that that the money they have lent to you is safe. What happens if you miss an interest payment on a HELOC?
Well, if you just miss one and then quickly catch it up, probably nothing. But if you miss one and you miss a second one, what happens to a HELOC is any available balance disappears. A couple of really important things
Oh,
differentiate a mortgage and a HELOC. A mortgage is a bilateral contract. You have rights, the bank has rights. So if you miss a payment and catch it up in 30 days, within 30 days, really nothing happens. There's a NSF payment to charge to pay, and that's about it. But nothing can happen. The bank can't pull your mortgage. It can't. It's not. You have to go through a lot of arrears for the bank to pull your mortgage, for the bank to take legal action. But that's not what a HELOC is. A HELOC is a demand loan. It's a demand loan. So on 24 hours notice, the bank can, if it can just eliminate the balance of your HELOC, just say, oh no, you've got $50,000 HELOC, you had 10 grand on it. Now you have a 10 grand HELOC and you better hurry up
right.
and pay us back. Okay. They can do all those things. They can demand payment immediately. And if they could look at trying to find ways to get that money out of you. So a mortgage and a HELOC are radically different products.
What is the single most important thing to know about oneself, one's spending patterns, one's temperament, one's discipline that might inform whether or not you accept a lender's offer to set up a HELOC? Because you meet all sorts of people and they have different strengths and weaknesses. Some people are just, for whatever reason, much more at risk for some of the bad behaviors you describe.
Sure. If you want to try to make a basic decision, look at how much of credit card balances you carry every month. Like if you pay your credit cards to zero every month, that you never pay a dime of interest, I think you're pretty safe in taking a HELOC. I think
Right.
you've got spending under control. If you look at your credit cards, you say, I'm always running a $20,000 balance forever on these three cards. Between the three cards, I run 20 grand and I chip away at it some months, but really it's been there for a few years. You may not want to take a HELOC. You may
Right.
not want to do that because you get a lot more capacity for borrowing at a better rate, but a lot of capacity.
That's the reason I could never work in an ice cream shop.
Me neither.
I There's just no way I could. It is enough for me to have a carton of ice cream in the house, just one single carton, because I'll consume much of it.
This Haagen-Dazs does this thing with some peanut butter and some chocolate and some, yeah, it's not easy, man. It's not easy.
Yeah, yeah. Well, at least I have a taste for cheaper ice cream than you. Haagen-Dazs. I mean, that's bougie. I'm buying like no-name ice cream bars over here. But
I'm not ashamed to say it. It's Haagen-Dazs all the way.
Ron, thank you for joining us today. Really appreciate it.
Thanks a lot. I loved it. Thank you.
Ron Butler, principal broker at Butler Mortgage, host of the Angry Mortgage podcast, and someone who's got opinions on virtually everything. Today, he shared them on his view of home equity lines of credit.